Hi there, and welcome to this week's lecture for Banking Risk 2. In this week's lecture, we're going to look at the first two measurement techniques regarding interest rate risk, and we're going to look at the repricing model and the maturity model. As we discuss these two models this week, the idea is to understand what they are, how they're applied, and the various advantages and disadvantages of both. But before we get there, we'll briefly explain what the likes of Basel require when it comes to any sort of measurement model for interest rate risk. As part of this, we'll briefly recap last week's lecture. Last week's lecture, we talked about the likes of interest rate change, interest rate volatility, and movements in the yield curve. And the movements in the yield curve is important because the likes of the repricing model or funding gap, it's also known as, depending on which textbook you read, the shift in the yield curve can impact profitability from an interest rate point of view. And it's the concept that the yield curve does not move simultaneously. The idea that if interest rates change, say the base rate changes, then the yield curve doesn't just shift uniformly along the curve. In other words, if interest rates drop by 1%, at the base rate level, it doesn't mean the whole yield curve drops by 1%. Maybe the short-term debt will move by 0.5%, but long-term debt would go down by 1%. So the yield curve might actually tilt rather than shift. So thinking about the yield curve and the yield curve theory we discussed last week is quite relevant for these models as well. So in this week's lecture, we're going to look at the repricing model, and then in part 2, we're going to look at the maturity model. Then next week's lecture, we'll look at the combination of these models in the form of duration. And I say combination, I'm not saying both measures get put together mathematically. What I really mean is that the repricing model is all about cash flow. The maturity model is really about economic value, the value of the assets and liabilities. So repricing, we're looking at really net interest income, or you could say bank profitability. Maturity, we're looking at the value of the balance sheet. So if interest rates change, how does that impact the value of the balance sheet? When we look at duration next week, duration is a technique that aims to combine both income and economic value. Before we dive straight into the first model, we need to have a look at why the likes of the Basel Accords advocate the use of such techniques. So as you'll know from your Banking Risk 1 module, Basel III has a number of pillars. Specifically, Pillar 1 is more about the capital and liquidity requirements for the banks, and Pillar 2 is all about the kind of supervisory review and how firms are managed. And as part of this Basel Accord, specifically to interest rate risk management, the BIS stipulate that any sort of measurement tool that's used by the banks must provide a fair comparison for their interest rate exposure. These models must also be used to then apply a certain level of capital requirement. Therefore, we calculate the interest rate risk, the actual nominal amount of risk, and then we hold the likes of capital against that, which, as you know, filters into Pillar 1. But the BIS also stipulate that any sort of measurement technique for interest rate risk management can't just focus on one aspect, i.e. profitability or economic value. It does suggest that any sort of measurement technique that banks use, it must incorporate both balance sheet exposure as well as tradable securities exposure. So it's not just on the balance sheet, it's also off balance sheet. To get more information about how banks should measure and manage its interest rate risk from a regulatory perspective, please visit the BIS website and search for interest rate risk on the banking book. So this document, interest rate risk on the banking book, was actually published in 2016, which updated the 2004 requirements for measuring interest rate risk. If you do access this 2016 document, it will stipulate that it has now been embedded within the Basel III consolidated framework. So the 2016 document is still relevant, it's just now it's embedded within the full Basel framework. Within this Basel framework, any sort of measurement model that banks use, they will stipulate at least these 5 criteria. So of course there is standardized models which everybody can use, but most banks, given their complexity and disparity between one another, then they may have their own internal approaches that are kind of calibrations of the measurement techniques we're going to talk about. But whenever a bank does make a model to measure any sort of risk, for that matter, and these do link to interest rate risk in the banking book document, but it's quite universal against the other measurement techniques you'll cover for the other risks, you've got to satisfy at least these 5 criteria. I mean, the first one's pretty obvious. You must do what it says on the tin. If you're trying to measure sensitivity of interest rate risk, then the whole model must measure interest rate risk. I mean, that's quite obvious. But as well as this, it must also be able to take into account any sort of hedging techniques or diversification approaches the bank does to mitigate the likes of interest rate risk. The second criteria that any model must satisfy is that it needs to be adjustable. It can be calibrated to take in stress periods. So of course the likes of any model will be used to stress test, and you'll stress test this against worst case scenarios, historic scenarios, and current scenarios for that matter. If you do look in this document in Annex 2, it does actually provide you a list of various different kind of calibrations or stress test scenarios that banks should really do. The next criteria is it must be, to the best ability, simple. And the reason for this is a more simple model is easier for regulators and interpreters of the results to understand. If you have the likes of a black box scenario where you put numbers into a black box, it spits out an outcome, chances are you won't know how to interpret that outcome because you have no idea what was in that black box. So any sort of model, it does have to be as simplistic as it can be to allow for consistency and comparability with the likes of other banks. And of course, the likes of regulators do need to understand the model as well, because if you blindside people with complexity, then does it actually solve the problem? With any model, it can't be heavily relied upon. If you think back to the financial crisis, there was a standardized approach that everyone understood called value at risk, which would have covered extensively in Banking Risk 1. Everybody heavily relied on this simplistic method. Everybody did value at risk, everybody got the same answers, everybody reacted in the same way. So the fact that everybody was using it was actually not a good thing. So there is an argument for model diversity. In other words, use a range of different models so you can interpret them and analyse them with a more holistic view rather than relying on solely one model. And that goes across within the bank and across banks. And then the last setting criteria for any sort of risk management model is that there must be some sort of credible fallback. So you might have these sophisticated techniques that the banks use, but there has to be some sort of standardized model for everybody to fall back on and a quite uniform, simple internal approach that everybody understands. So whenever we do these sort of measurement techniques, there will always be like a standardized approach. Quite frankly, the ones we're going to talk about today and next week is kind of standard approach that every bank will use. But then of course on top of that, as part of their risk management suite, they will do their own additional, more advanced models. But these 3 models we'll talk about will definitely be kind of credible fallbacks that everybody understands. So let's move on to look at the first model. And this is what's known as the repricing or funding gap model. And if we think back to last week's lecture, we finished off by talking about refinancing and reinvestment risk. And this is where the likes of the gap model comes into play, because we talked about the fact that if the likes of an asset ends and a liability continues and we have to reinvest, then we need to potentially reinvest and get a new asset that returns more income than the liability. And obviously on the flip side, the likes of assets which typically are much longer, if an asset is returning us a rate, we need to fund that asset or keep rolling over shorter term liabilities to fund that asset and make sure that the income from our asset is greater than what we pay out on our liability. So this repricing fund model is all about net interest income. The main focus is simply on cash flow. And cash flow at different points in time. It's a basic calculation, to be fair, about what interest do you have coming in minus what interest do you have going out. So it's a profitability measure as well. It's not looking at economic value. It's not looking at the value of the assets or liabilities. It's really looking at the balance sheet, the assets and liabilities at the current nominal number, and then working out how much the interest on that nominal number will change if interest rates change. So it's also kind of a book value accounting measurement technique. It's really looking at the book and then applying a certain income or expense on them piles of assets and liabilities. So the key point for this is it's basically looking at cash flow at different points in time on the balance sheet. And of course, banks forecast this. Banks will potentially know how much they're going to have to pay out or what they're going to receive in interest on various products at different points in the future. So that's what this model is all about. Cash flow, net interest income. It's nothing to do with economic or market value of the balance sheet. And there is a simple mathematical calculation when we're working out this repricing model, and that is rate sensitive assets minus rate sensitive liabilities. But it's about the income from these assets and liabilities. So it's essentially looking at what is the interest that we receive on our rate sensitive assets minus the income we get from paying out on our rate sensitive liabilities. Now obviously we need to work out what we mean by rate sensitive first of all, and then we need to work out the potential interest rates that are charged on the assets and on the liability side. Now obviously on a whole balance sheet level, you're not going to know, if you look at a bank's balance sheet, what the average percentage is on a group of assets or what the average payout percentage on interest rate of certain liabilities. All we can do is look at the potential size of the rate sensitive assets compared to the amount of rate sensible liabilities, and then do the calculation of rate sensitive assets minus rate sensitive liabilities. And then we can explore the gap. So if you have a look at the two diagrams at the bottom, obviously the positive gap is the case where you have more rate sensitive assets than rate sensitive liabilities, because obviously that would be a positive gap if you do the mathematics. And then on the flip side, a negative gap would be if you had more rate sensitive liabilities than you did rate sensitive assets. In order for the banks to calculate this repricing and funding model, the first step is to work out what actually constitutes as rate sensitive. And these are assets and liabilities that their income changes if interest rates change. So the first example to disclude would be the likes of bonds. Bonds wouldn't be classed as rate sensitive because, as you know, a typical bond is simple interest, where the coupon typically is fixed, and that will obviously continue until the bond ends. So the income of a bond does not change, therefore they would not be included in this. The next model that we'll talk about, obviously if interest rates change, the value of bonds change, but this is not what this model is looking at. It's only looking at the income. So the first task is for the bank to look at its assets and liabilities and forecast incomes off each individual product that yields an interest, and only include the assets that are rate sensitive. It doesn't include the assets that have like a fixed income or a fixed outcome. But this slide gives you an idea of potential items that are excluded from this model. So anything that really pays a fixed level of interest, or any sort of regulatory capital that is obviously not an interest-bearing asset or liability, because it's the likes of equity. And also what's missing is any off-balance sheet items. Before we get to the advantages and disadvantages later, you can already start to see some problems in this model, that quite a lot of the balance sheet is not included, but also off-balance sheet items are not there. But then if we think about things that are going to be included, then you've got to predict the income or outgoing of all these assets and liabilities across various time horizons. And we're assuming here that the income and outgoing is going to continue. In other words, there's zero credit risk. We talked about one of the sources of interest rate risk being optionality, and that customers may pay off products early, or they may withdraw their cash early because they have that option. So we have to assume no credit risk and no optionality here. So we'll come back on that later on. So as part of this technique, the bank has to forecast its net interest income, its various ingoings and outgoings at various time horizons. And it does total these 19 different buckets of where they've got to potentially forecast what is their net interest income at these various different buckets. But obviously you can imagine that there'll be disparity between overnight and greater than 20 years, because as we talked about last week, assets tend to be much longer term than liabilities. So chances are you don't have many liabilities that have time horizons greater than 20 years, but you'll have lots of assets that you'll forecast for longer than 20 years. So when we apply this to a real bank, you may see a very different net interest income across these 19 different buckets. Let's do a fictitious example now. So we have a simple balance sheet here. And what we've done is we have included all rate sensitive assets and liabilities. So in here we've already excluded things that are non-rate sensitive. And when we do this calculation, in this example, we've only give 6 different buckets. And as you can see from the asset and liability, all we've done is looked at the kind of nominal value from assets and liabilities. And in the first column, we've suggested that the net interest inflow, what comes in from your assets, is 20 million, but what you pay out is 30 million. Therefore, from a net interest income point of view, you can see that we do make a potential loss, and that is of minus 10 million. So that doesn't look like a good thing. However, as you slowly go down the various different cash flow time horizons and buckets, as we get to the greater than 1 year and plus 5 years, because remember, assets are more long term relative to liabilities, then it starts to become profitable. So when you get to the greater than 5 year time horizon, you can see that overall we have a zero gap, but in the short term it's a negative gap. But this is not that uncommon, and that again goes down to the point that assets tend to be more longer term than liabilities. So what we've done there is we've ascertained that overall there's a zero gap. But what the bank has to do is measure this at the various different buckets. So if we move on and we kind of look at the rate sensitivity, so if interest rates change in the short term, how does this impact our profitability? So if we look at the example of overnight, and on here we have a simple calculation. We know the gap is minus 10 million on rate sensitive assets and liabilities, incoming and outgoing. The calculation, all we've done here is if interest rates were to change, and if we say that overnight interest rates change by 1%, then we know the gap is minus 10 million. We apply that 1% change in, and therefore that means our losses would go up by 1%, £100,000. So when we do the calculation to test sensitivity, so net interest income sensitivity, we look at the size of the gap, okay, minus 10, overnight we make a loss. If interest rates go up, that loss will increase slightly further by 100,000. So that's it, the less than 1 day. If we jump forward now and look at the likes of net interest income sensitivity over a year, less than 1 year, then we know the cumulative gap is minus 15 million. Again, if interest rates rise, then our losses increase by 150,000. But as part of this, we do have to kind of ask ourselves the question that because everything's less than 1 year, what is the likelihood of interest rate change? And typically, a bit of a broad statement, but most liabilities that are less than 1 year are not that rate sensitive. They're more likely to be fixed. So we have just kind of pooled what we consider to be rate sensitive assets and liabilities together, looked at the income and outgoing, looked at the size gap, and applied a sensitivity change to that. But obviously, this is a snapshot in time. We talked about the predictability of the yield curve last week. If the likes of the managers acknowledge that the interest rates might change, then they might already have done something about this and potentially issued new short-term liabilities at a different rate, at a lower rate, to counteract this potential loss. So these things we have to kind of acknowledge, and that the fact that this model is really looking at book data and it's doing a very simplistic sensitivity analysis when there's so many variables at play. But let's try an example for yourselves now. Let's have a look at this balance sheet. We've got assets on one side, we've got liabilities on the other side. Obviously it's a balance sheet, thus it matches. Take time now to stop the video and have a look and write down which assets and which liabilities you'd consider to be rate sensitive at less than 1 year. Okay, so I hope you've done that now. So let's have a look what you should have included for anything that is rate sensitive at less than 1 year. Well, essentially anything that is less than 1 year is obviously going to be potentially included. Anything longer than 1 year, do exclude. So if we look at the asset side to start with, you'll have short-term customer loans. We wouldn't include medium-term loans because they're medium-term, which suggests they're longer than 1 year. We've got the 3-month T-bill and the 6-month T-bill. Now you're probably thinking, well, T-bills are issued at a discount, and therefore if we hold them, then that's technically fixed. Well, they are during the 3 and 6 months, you could argue that. However, it's the fact, if you look at the second column there, it's the fact that at the end of the 3 months, you roll it over, and you don't know what that rollover is. And that's where it becomes rate sensitive, is at the time of rolling over. So we include the 3-month T-bill and the 6-month T-bill. 3-year bonds exclude because they're bonds for 3 years, typically fixed coupons. 10-year fixed rate mortgage, again, that's not rate sensitive. We can forecast the income on that because it's fixed for the next 10 years. But we do include the 30-year floating rate mortgage because it tells you it adjusts every 9 months. Thus, every 9 months, the interest may vary. So it is rate sensitive. On the liability side now, we start by including things that, again, less than 1 year. So we can look at the likes of the 3-month certificate of deposit, the 3 months banker's acceptance, the 6 months commercial papers, and we can look at the 1-year term deposits. So we'll include them because everything's less than 1 year or it is rate sensitive at the end of the year. But here is a good question for you. What do we do about the customer deposits? So obviously equity capital we don't include because that's capital. But what about the demand deposits and the savings accounts? Do we include them or not? Now this is a kind of argument, and it could be a theoretical argument, but think about now, have a quick pause of the video and think, why could savings not be classed as rate sensitive? Generally, we might call them rate sensitive because if interest rates change, you'll know as a saver that the first thing to get hit is your savings interest payments. If you're a depositor you might not even get an interest rate on your customer deposits depending on your bank, but if you do, if interest rates change, you'll probably know the little bit of interest you get will go down. So does that mean they're rate sensitive? Because if interest rates change, then the amount the bank has to pay out on savings and deposits also changes. But it tends to be a very small increment. But the main point is that we don't actually switch bank accounts. Despite the fact that interest rates drop, how often do you start looking elsewhere to try and get more interest from another bank? So customer deposits, as I mentioned last week, are what's known as sticky because we don't change bank accounts. If interest rates change, then yes, the payment we receive as customers or the bank's outgoing will be less because they don't potentially charge that great interest on customer deposits. So from that point of view, they are rate sensitive. But the amount difference is very minimal, and the fact that we don't change bank accounts and we don't leave if interest rates change, then you could argue that they're not rate sensitive because the marginal difference is very low if interest rates change. But say for this example we just exclude it and we don't class them as rate sensitive liabilities. If you look at this calculation for 1 year, then we can look at the items we included, and then from the asset side that was 155 million, on the liability side that was 140 million. Then what we can see here is that we actually have a positive gap for less than 1 year because we have more liabilities that are rate sensitive than assets. And that's because we left out the demand deposits and savings accounts. If we include them, then the calculation would give a larger negative gap. So we have a positive gap for less than 1 year, and if we want to express that in terms of a percentage over total assets, we get this positive gap and divide it by the 270 million, the size of the balance sheet. And to express the interest rate sensitivity in this terminology is suggesting that our interest rate sensitivity is 5.56%. So the things that we really need to look out for is when we look at the gap in terms of the size of the balance sheet. So when we have the gap divided by the total assets, we're interested in two things. We're interested in the size of the gap. So here we've got the example, the size being 5.56% in terms of assets. If that was much lower, then it would be quite a small gap. If that increases substantially, of course, it would be a large gap. So we're interested in the size, but also the direction. Is it positive or is it negative? If it's a positive gap, we need to think. We have more rate-sensitive assets than rate-sensitive liabilities. So what does that look like from a profitability point of view? If it's a negative gap, we then need to think, well, how can we potentially fund assets in the future? Is there going to be a potential funding issue? Do we need to increase the amount of customer deposits or the amount of borrowings from the money markets? But if you think, we need to increase our customer deposits, then do we include them in the calculation in the first place, given their kind of special status? Whenever we do these sort of calculations, typically we do actually include customer deposits because they are the bulk of the liability side for most banks and certainly building societies. So typically we would include them in this calculation, because if we didn't, then the maths would look very different. For this example, we've pulled up real data from Barclays, and we use the 2018 data for this. And although there is 19 different buckets, as we mentioned earlier, we can only produce the maths based on what Barclays gives us. And Barclays do break down their asset and liabilities in these different buckets here. So what we've included on this asset side is we've looked at the balance sheet of what they produce in this table, and then we've potentially removed things that are not rate sensitive assets. And what we've tried to include is things that we consider to be rate sensitive, but obviously when we're looking at a balance sheet of book data, it's very difficult to tell, because within some of these, so say the top one, the loans and advances, some of them could be fixed loans for all we know. But we can't make that distinguishment, so we've included them. The things that we potentially excluded that you don't see in the table is we would have seen something the likes of trading and derivatives. So that was in the original table, but we've excluded them because they're trading assets, and we mentioned at the very start that's typically not what's included in this calculation. So at the bottom there we have our total rate sensitive assets. On this slide we've done the exact same process, but we've done it for the liabilities, and as you can see we have left in the customer deposits, because we didn't look at the size of the customer deposits, specifically at the shorter term. It's a large proportion of the balance sheet. So in this example, you can see at the bottom, when we got the total rate sensitive liabilities, we did the maths where we minus rate sensitive liabilities from rate sensitive assets from the previous slide. And you can see here across the various buckets for Barclays, you can see the short-term payouts is much greater relative to longer term where the income is positive. And as we noted before, that's what you'd look to expect. Assets tend to be longer term compared to liabilities. And overall, we've ascertained that the gap is negative, 180 million. Thus, they have more rate-sensitive liabilities than rate-sensitive assets. Whenever we do this calculation, we've just applied a simple net interest income sensitivity and said if interest rates increase by 1%, then how does that impact our profitability? It drops. If interest rates increase by 5%, then that really does hamper the rate sensitive assets and liabilities, and therefore we make a much greater loss. But as you've noted, if interest rates do go ahead and actually decrease, then that benefits the bank, because we're paying a lot out in liabilities compared to assets across this balance sheet. So if interest rates decrease, then that really helps us, because it really shrinks the amount of payouts we have to do compared to what we receive in. So whenever you see a negative gap, then you could think from a management point of view, Barclays expected interest rates to drop because their balance sheet was set up to take advantage of an interest rate dropping, because that would make them more profitable if interest rates dropped. But to do a full analysis of this, we should really compare to last year. So we'd want to do the full exercise and grab the 2017 data and have a look at the size of the gap. Was it quite similar to this? In fact, was it 180 million? And was it still negative then? Because if you do this across 2 years, and if you see the directional change or the size of the gap change, then that's obviously something the management of the bank have done within the Treasury Department of the bank, because they have to make a prediction on where they think interest rates are going. So from this, you could interpret it that we believe that Barclays thought in 2018 that interest rates could drop further, and that their profitability would help if interest rates did drop, as noted over here. Obviously, when you look to calculate this yourself for a bank, then there is a vast amount of assumptions that we've taken into account here. We've assumed what we consider to be rate-sensitive assets and liabilities, and we haven't applied a specific amount of interest per item. We've just looked at the nominal figure, worked out the gap, and applied a sensitivity of 1 or 5%. But obviously, in the bank's balance sheet somewhere, in the annual report, it will give you a sensitivity analysis itself. There will be a section in the annual report which will say, if interest rates go up by this, our net interest income will do X. So it will produce in its annual report its own interest rate sensitivity. So you can do this exercise, but you should also go into the bank's annual report yourself and look for net interest income sensitivity, which is a similar exercise, but done internally. And it won't give you any information except from maybe this sort of sensitivity analysis here. So it might be good to kind of compare what you did compared to what the banks say. In this example, we have made one other critical assumption, and that is if interest rates increase by 1%, then we're assuming that across the whole yield curve, interest rates change by 1% uniformly. In other words, the short term on demand shifted by 1%, but also did products at the 10-year shift by 1%. So we've assumed the yield curve across these maturities is shifted simultaneously. Now we know in practicality that doesn't happen. If base rates change, the yield curve will tilt. One end will move more than the other end, depending if it's positive or negative. Going back to our previous example where we had the Northumbria Bank, we had this less than 1 year gap of 15 million. When we looked at sensitivity, we say if interest rates were to go up, then that would help our net interest income. If interest rates went down, that would hamper our net interest income. But we said that would be if it was uniformly interest rates across the yield curve between overnight up to 1 year. That assumes a shift of 1% across that whole yield curve between 0 to 1 year. Does that happen? In practicalities, no, it doesn't. So it does get a little bit more complex, where if there is a change in interest rates, how does this impact assets and liabilities differently? Well, let's think on a practical note for a second. If interest rates were to increase, do banks simultaneously put that onto its liabilities or onto its assets? If interest rates increase, it'll probably increase the interest rate on its assets, its loans, its mortgages first. And then later on, it might start increasing the likes it pays on customer deposits. When interest rates drop, typically they'll put that onto its liabilities first. So if interest rates drop, you'll probably see your customer deposit or savings account interest rate drop quickly. compared to any sort of loan that you receive. If interest rates go up, mortgage holders or people that have loans on a variable rate, that'll probably get put on simultaneously. But trust me, they'll be pretty slow at increasing the amount of interest they pay on deposits. So there is that kind of practicality unevenness. So we have an example here where we said if interest rates go up, they'll put that on the assets income more than they would on the liability side. Makes practical, profitable sense. So if this was the case, we'd have to kind of go back to say, well, what was the total amount of rate-sensitive assets times that income by 1.2? What was the outgoing on our rate-sensitive liabilities? And only times that by 1%. So then you can see how that impacts overall net interest income change. From the bank side, if it's the opposite, and if the rate-sensitive liabilities rate increases more than rate-sensitive assets, in other words, the yield curve flips, this would really hamper the sensitivity of net interest income. And you'd see that banks have to pay out so much more than what they receive. So that goes back to what we were discussing last week, the fact that the managers in the Treasury Department of the bank need to look at the yield curve and try and forecast any future changes to ensure that the likes of their net interest income is not hit if the yield curve changes. So just to summarise the advantages and disadvantages of this approach, well, you can see how simple it is. It doesn't take us much to work out what potentially is rate sensitive, what is not. We're only looking at the book value here, and then we're applying a simple sensitivity rate, and we're kind of assuming that interest rates across the yield curve change simultaneously for the majority of the time. We know that's not true. So it is simple, it's okay for forecasting profitability, but there's a lot of disadvantages here. We have to forecast a lot of different things. We're assuming no credit risk, we're assuming no optionality. The yield curve, as we discussed last week, it doesn't change uniformly. It shape tilts rather than shifts. It's also potentially ignoring the timing of the cash flow, because it's assuming that we get a cash flow at these different buckets, but does the actual cash flow come in that bucket, or does it go into the next bucket? So we're potentially assuming the cash flow timing of this, and it is ignoring economic value. It's ignoring the value of the assets and liabilities. And then we don't know what to do with deposits. We have to assume they're non-rate sensitive, but we can include them in the calculation anyway, because they're the largest proportion of the liability side of the balance sheet. So there is a range of various limitations to this model. And this concludes part 1. Hello and welcome to the second part of this lecture on the repricing and maturity model. And in this part, we're going to go through the maturity model. Now, the first thing to note about the maturity model and the examples I'm going to give in this part of the lecture, they're going to be regarding fixed income, specifically bonds. So you should understand how bonds are priced and the fundamental characteristics of a bond before you proceed watching this video. So I would recommend that you recap your knowledge of bond pricing, or you can continue to watch, and I hope from how I explain things it re-jogs your memory. So the maturity model differs from the repricing model. The repricing model, as I've already mentioned, is all about cash flow. The maturity model is all about economic value. It ignores cash flow. Essentially, it says if interest rates change, go up or down, how does that impact the value of the balance sheet? So if interest rates were to change and the likes of the assets fell in value, then of course the liabilities would have to also fall in value because it's a balance sheet. But think about what's on the balance sheet side, on the liability side. Equity, ownership, market value. If your assets shrink, then your liabilities shrink as well, and that means your capital, your market value, the value of your business drops. And when regulatory capital is squeezed, this is where the regulators get a bit nervous, because your ownership level has dropped. Your value of your business has dropped. And from banking risk 1, regulatory capital is obviously seen as a keystone in pillar 1 to help the safety and soundness of individual banks. So the maturity model. It's about the value of the balance sheet. And it does focus more on the likes of fixed products, but throughout the examples we use the balance sheet as a whole. It's just easier when I give the examples using bonds. But before we go into the actual mechanics of calculating the maturity model, there's a number of rules that we need to remember, and I'll demonstrate these rules using maps as well. So the first one is the concept of an inverse relationship between interest rates and market prices. So what you'll know from your pre-reading is if interest rates go up, bond prices go down, which push yields up. If interest rates drop, bond prices go up, yields come down. So you'll probably be familiar with them characteristics already. Number 2, the longer the maturity of an asset means its price is going to be more sensitive to interest rate change. So if you have the likes of a 30-year mortgage and interest rates change, the value or price of that mortgage will change much more than anything that is a 1-year loan. Because it has a longer time to maturity, it is much more price sensitive. So you'll see longer dated products change more in value. And this leads on to the third point about how this diminishes over time. So if you had this 30-year mortgage, or we'll say a 30-year bond, if interest rates change in the first few years of the bond, the price is going to swing a lot. But as you get towards the end of that bond, say 1 year to go, as you'll know from your bond pricing lectures, that as you get closer to the end date, the bond price gets closer to the par value. So if the par value of a bond is 100, then very close to the maturity date, the price isn't going to swing too much around 100. But if it was today and the bond ends in 30 years' time, you're going to get £100 in 30 years' time. So that bond price today can swing massively. So as time goes on, the price swings kind of start converging towards the par value. And point number 4 here is that when interest rates go down, it actually has a greater impact on market prices than if interest rates go up. And we've observed that from historical evidence. But also, kind of think from a practical point of view, why do interest rates drop? Interest rates drop are normally seen as trying to kickstart the economy, which we talked about in lecture 1. So if interest rates are decreasing, that suggests that there's potential economic nervousness, and when economies aren't doing so well, prices in general get suppressed. But when interest rates rise, this isn't the effect. So decreasing interest rates tend to have a greater impact on the value or the price of an asset or liability. Okay, so I'm going to show you these rules with a few examples. So we'll start with example 1. So all we're doing here is just showing you how the likes of a 1-year asset can change if bond yields change. So the top half just suggests that you have a £100 bond with 1 year to go, and the coupon rate, the interest payment, is 10%, but the yield to maturity is also the same at 10%. So if the coupon rate and yield to maturity is the same, then the bond price should be the par value of 100, as you can see from the bond pricing calculation there. But the second half, it shows you that the likes of central bank has tightened monetary policy. When we talked about why interest rates change last week, then this pushes up the required yield on the bond to 12%. So So therefore, in the calculation, the coupon, it's fixed. Coupon's fixed at 10%, £10. So the top half of the equation stays the same, but the rate on the bottom half changes. So now, because interest rates went up by 1%, the bond price fell in value by 90 pence. So this is just showing you that if interest rates go up, bond prices go down, therefore the capital loss, if this was your asset side of the balance sheet shrunk by 90 pence. Let's look at another example now, and this time we're going to look at the liability side of the balance sheet. And this time we're not too interested in the yield, because it's a liability, we're interested in the level of interest on the bottom half. So in this example, we have just a 1-year term deposit, which gives a fixed rate of 10%. And the current level of interest is also 10%. Thus, same equation, same calculation. Therefore, the price, the market value of this customer deposit is £100. In the second half, similar example, if interest rates increase, then the new 1-year deposit will rise by 1% up to 11%. And if this happens, again, similar calculation, you can see the value of the liability also drops by 90 pence, £99 and 10 pence. But this time, let's think, where has the 90 pence gone? Well, the 90 pence on a balance sheet, if that drops, then what do we do to plug that gap? Well, this is where capital comes in. Will you have to raise additional capital to plug the gap from this liability dropping in value? We'll explore that in an example later. Also, if you think of items like liquidity risk, this wouldn't be good if this customer deposit, this liability, if the bank had planned to sell off this liability, wanted to sell its customer deposit portfolio to another bank, for instance, then the value is being depressed because the value's gone down. So in the likes of liquidity crises or depressed price markets, then if you're trying to sell off liabilities that are falling in value, that's going to suppress the price more. So there's other things like that we can think about. And let's look at this third example now to highlight the concept I was discussing before about that the longer dated products, their prices tend to move further. So in the previous two examples, we just had a 1-year product. In this case, we're going to look at a 3-year product. So what you can see at the very top is the same bond where you have the coupon and the par value, and that is with an interest rate of 10% on the coupon and the yield to maturity being 10%. You can see the price of the bond is 100. But let's suppose that the market rate actually rises to 11%, and that's from the start. So you've got this bond which pays a coupon of 10%, that's fixed. So we change the rate on the bottom half of the equation to 11%. If interest rates stayed the same and the yield to maturity and coupon matched, the bond price is 100. But if it goes up by 1%, therefore the bond price then drops to £98.29. But to prove the point even more, let's suppose this is a 3-year product. If we expand that even further, then you can see if we can't roll it on for another year, do the maths, then if it was a 3-year product, the 1% increase in interest rate actually means that the bond price would drop to 97.56. So you can see as the maturity date increases, then the price of the bond at the start can swing much more. So then we have a few examples to highlight and reinforce the rules that we discussed at the start. Now let's explore the market value of a balance sheet with these concepts in mind. And we're going to use some of the maths from the previous slides within this. So we've got a simple balance sheet here. We've got a long-term asset, which is 100 million at 3 years. Then on the liability side, we have a 1-year liability at 90 million. and then equity ownership or capital at 10 million. So you can see each side is 100 million. And we have some formulas at the bottom. So to work the net worth of any organisation, so it's the value of the assets minus the value of the liabilities. And then if we want to assess any change in net worth, we need to see how much the asset changes and minus that off by how much the liability changes in value. So we're going to use the same example as before, certainly for the asset side. So on the asset side, we have this 3-year product, and we have it as the bond that we used before. So we assume that interest rates were 10% and then they increased up to 11%. How would that impact our 3-year bond? As you've seen from 2 slides ago, our £100 product, when interest rates went up by 1%, because it was 3 years, then the value of that bond dropped to £97.56. So that's where the maths came from on this side, 2 slides ago. On this side, however, we're just looking at the liabilities. So we're only looking at the 1-year product. So we suppose that this 1-year product with a value of 90 million, if interest rates were to change by 1%, then this 90 million would drop to 89 and 19 pence. In this half, for the moment, just ignore equity, okay? Ignore that for the moment. So on this side, we've just said interest rates go up, the asset drops to this value, interest rates go up, the 1-year liability drops to this amount. Let's look at the overall value of our organisation using the net worth formula before. We minus the liabilities from the assets. So the net worth of our organisation now, of our bank, is 8.37 million. And we can work out that that's a drop in 1.63 million. But where's that drop come from? It came from here, equity. Beforehand, when all else being equal, our equity, our value of our organisation was 10 million. Interest rates went up, assets went down quite a lot, the liability side went down by a little. Because the balance sheet has to match, what took the hit? The value of our balance sheet took the hit. Our equity is not 10 million anymore, it is now 8.37 billion. Our value of our organisation dropped by this amount. And now this is summarised in this slide. So you can see there, the asset dropped to this, the liability dropped to this, thus these two have to match, so equity ownership is this. So from this brief example, you can see if interest rates go up by 1%, the equity dropped by 1.63 million. This is what the likes of managers want to avoid. Why do they want to avoid this? Well, no one wants the value of their organisation to drop, but also this is regulatory capital. Your capital, your equity is shrunk. This becomes a regulatory issue if this gets suppressed much further. There is other things to think about as well. There's also the time value of money effect. Just got another example here to suggest that anything with longer maturities, their price would move more if interest rates change. So this is a case where you could stop the video and do some of the mathematics behind this to recap yourself on how the pricing of zero coupon bond works. But in this example, we have the current market value of each asset being 1,000. So if you want to invest 1,000 now in this 10-year zero coupon bond, you'd pay 1,000, and then in 10 years' time, you'd receive this amount of money back. Likewise, on the 20-year bond, if you invest 1,000 now, you would receive back £3,207.54. This is assuming that the interest rate in the market is currently 6%, but if interest rates were to go up to 7%, so up by 1%, then the value of this zero coupon A would drop from 1,000 to 910, but B would fall much greater to 828. So what you can see there is the product with the much longer maturity, if interest rates drop, their price drops much greater. So please do try and practice the maths given the information on the slide there. There's also other things to factor in, which, as I noted, the likes of the maturity model doesn't as such, but you could also note the element of cash flow and the timings of cash flow. So if you have the likes of a bond that pays more frequently, so if you have bond A here that pays a coupon more often than B, which is just at the end, then that price wouldn't move as much. That's bond A. Because you're getting the cash back quicker, then the value would not move as much. And this concept here is actually what we'll be exploring in detail when we do next week's lecture, duration. Because duration tries to take into account both cash flow, time of payments, and economic value. So this concept of paying back sooner means prices don't swing as much. That'll be discussed and explored in the duration model. Now that we've covered the rules and some of the basics, let's understand how to actually calculate the maturity model itself. And for that we will use an example. Now don't be put off with the formula here. I'll just show you the steps in a second. But in order to calculate the maturity model, you need to look at the portfolio of assets to start with. And you need to weight the average maturity of each component of the assets on the balance sheet. So for instance, within each maturity bucket, we're going to compare how much assets you have in that maturity bucket relative to all total assets, and then weight them accordingly. And we do exactly the same on the liability side. We look at how many liabilities they have in a certain time bucket, and then we weight that relative to total liabilities. So it's easier to show an example now. We've got exactly the same example of Barclays. What you can see is the different maturity buckets that the bank produce. Here in the maturity, where have these numbers come from? Well, basically 1 divided by 12 is 0.08. 3 months in a year is a quarter, 6 months in a year is a half. 1 year, 1 year, 2 year, 2 year, and so on. So that's where that's come from. Here, we just have our asset breakdowns. Ignore the acronym. These are literally just straight from the balance sheet. How many assets are in this bucket? How many assets in this bucket? Again, this is how many liabilities in this bucket, how many liabilities in this bucket, and so on. So that's very similar to the data we had before, but this is both rate sensitive and non-rate sensitive. It's just the balance sheet in absolute. So that's the first step, is just to transform maturity into out of one. The next step, when we've got the raw data from the balance sheet, is to work out how much of this asset relative to total assets. And as you can see, we've added up all the assets and it equals 1.1 mil. So therefore, this is 50% of total assets. So this here just represents this as a portion of total assets. And this one here, as you can see, is on the liability side. This 60% demonstrates that these liabilities that are less than 1 month as a proportion of total liabilities. So for this bank, you can see that in less than 1 month, that's where the majority of the assets and liabilities actually cease and end. So the maturities of the majority of this balance sheet is less than 1 month. And then the last part of this is to do the weighted average. So this 0.4 is simply 50% times 0.08. Equally, this 0.47 is 60% times 0.08. And we just do that for the whole balance sheet, where applicable. And then lastly, at the bottom, you total it up. So the total of that column is that, the total of that column is that. Then lo and behold, the maturity gap is 0.11 minus 0.6. So in this Barclays example in 2018, the maturity gap is 0.49. It's positive. And if we look at the previous year, you can see it was very similar. It was still positive, but the gap is slightly increased. So that's the mechanics of how we actually calculate the maturity gap. The next step is how to interpret what this 0.49 actually means. So just like the previous model, when we interpret it, bearing in mind all the rules we've talked about, then we need to take into account the size of the gap, the 0.49, and also the direction in the fact that it is positive. So for instance, if we look at the interpretation here, it's a positive gap. So if interest rates were to rise, then the market value would drop because it's a positive gap. If interest rates were to go down, the economic value of this balance sheet would increase. So if you have a read through the interpretation and the words there, it says, as interest rates rise, the net value of the assets will fall greater than the net value of the liabilities, therefore the capital will shrink. Very similar to that simplistic balance sheet I showed you earlier on. So if it's a positive gap, interest rates go up, market value goes down. If you have a negative gap, if interest rates go down, economic value also goes down. If you have a negative gap and interest rates go up, economic value goes up. So in the event of a positive gap, this one, the relationship's inverse. But when you have a negative gap, this one, if interest rates go down, market value goes down. If interest rates go up, economic value goes up. So in this case, with the likes of Barclays, because it had a positive gap, then that would take advantage of if interest rates went down. So just if you remember part 1, the balance sheet was set up from an income point of view. If interest rates dropped, Barclays would be more profitable. In this model, if interest rates go down, economic value goes up. So Barclays were clearly set up expecting interest rates to drop, because if interest rates drop, then their interest income would go up and the economic value of their balance sheet would go up. So if you compare the two in that sense, then we can see Barclays were expecting interest rates to drop. But what happens if we do this mathematics and then when we do the formula and the gap is 0, it's nothing? Then this is what's known as immunization. It's got nothing to do with vaccines, given current affairs. Is this a good thing? Do we want a gap of 0? Therefore, if interest rates go up or if interest rates go down, the balance sheet stays the same. One thing we have to note is that this model does not take into effect of timing. It doesn't know when the cash flow and the payments are to be received. But let's look at an extreme example here. You might have an asset which is a 1-year loan, but this loan might be paid back very quickly, but it's still 1 year. So you might receive all of the loan back on the first day, except from 1 pence, which might be returned at the end of the loan. So you could get 99.99 on day 1, and then get the 1 pence back at the end. And that could be funded with a liability of a 0 coupon bond, which pays nothing at the start and 100 at the end. So the cash flow time horizons are very different. The asset basically paid you everything back nearly on the first day, but the liability leaves it all to the end. But from a maturity point of view, they're immunized because they both end in 1 year's time. We didn't realize that the asset paid the majority of it back on the first day and left the last penny to the last day, unlike the liability, which was the opposite. And as we noted earlier on, that cash flows and payments do impact economic value as well as the time horizon. There's also other things to consider, the likes of leverage, the concept of borrowing to fund assets. In this example here, you have an asset, which is 1 year 100 million redeemable bond, which pays a coupon of 10%. And this asset is funded on the liability side by a 90 million 1 year deposit and some equity. Again, this balance sheet, it's immunized. Both balance sheets, asset and liability side, end in 1 year. But this is the exact example that we give on the simple balance sheet at the beginning. The asset side is subject to more interest rate risk, greater than the liability side, because the likes of equity is not subject to the interest rate risk. It's the funding customer deposit and the asset. And leverage obviously assumes borrowing. The more you borrow, then that borrowing on the liability side really might change the interest rate risk dynamics relative to the assets. So leverage is also another factor. Then if the balance sheet looks immunized, then this might be because of leverage. So do some reading on the impact of leverage on a bank's balance sheet. And to summarize this model, the advantages, well, it is arguably simple. The example from Barclays that we did didn't seem like it was too difficult to work out. It's a good predictor of market value, and it gives you an indication if interest rates change, how that would impact the economic value. But the disadvantages, well, it doesn't incorporate cash flow. The timings of any payments from these products are not taken into account. We also don't take into account the likes of optionality and default risk. We just mentioned there the concept of leverage is not taken into account. Off-balance sheet items are also missed when we did the example of Barclays, which just used the balance sheet data in absolute. And anything over 5 years, as you'll see from the balance sheets, they just tend to be grouped together. So in the later buckets, it's very difficult to distinguish the difference between a 5-year product and a 30-year product. And as we've said, the longer the maturity, the more the price swings. So if you group them together, it's harder to decompose that in the calculation. There is a number of disadvantages there. This concludes this week's lecture. So in the seminar, we're going to look at potentially calculating or understand these models further. You've got your recommended reading there, linked to the core textbooks of where these are covered. But do go back, understand the mathematics, and potentially pick your own bank and try and do the similar calculations following the Barclays examples to do these models on a different bank. Thank you.